Welcome back to the deep dive. Today, we are packing our bags. Figuratively speaking, of course, unless you're actually on a plane. And we're heading to a place that, well, let's be honest, it dominates the vision board of a lot of business founders right now.
Oh, absolutely. We're talking about the United Arab Emirates.
UAE. And you get it. You really do. There's this whole Dubai dream, isn't there?
The skyline, the zero tax history, this idea that you can just land, sign one piece of paper, and you're a global tycoon by the weekend.
Yeah, exactly. And honestly, the dream exists for a reason. I mean, you've got this incredible political stability in a region that can be, well, volatile.
Right.
You have infrastructure that puts a lot of Western cities to shame, and you're geographically positioned right between the East and West time zones.
And maybe the most important thing for anyone in business, a currency that's pegged to the U.S. dollar.
That peg is huge. It's a massive safety net, right?
It is. It just removes this entire layer of Forex risk that, frankly, kills businesses in other emerging markets.
So it feels like the perfect launch pad. But there's always a but. On this show, we're not here to, read the travel brochure.
No.
We're here to talk about a very specific and often very expensive trap that a lot of smart people fall into.
It's what we call the cheap trap. And it's so insidious because, at first, it looks like a bargain.
So today, we're unpacking a document called the UAE Jurisdictional Strategy and Operational Compliance Guide. The mission here is pretty simple. We want to get past that glossy sales pitch.
The set up your business in 24 hours for $500 pitch.
That's the one. And look at the gritty reality of the plumbing.
The plumbing, I love that analogy.
Yeah.
Because that's exactly what it is. It's the boring stuff, banking, compliance, audits, visa quotas.
The stuff that if you get it wrong...
The pipes burst and your whole house floods.
And the biggest pitfall, according to our sources, is that founders treat the UAE like a menu. They order the cheapest item.
They do. They scan this list of jurisdictions. And there are over 40 free zones in the UAE, which is a marketplace in itself. And they just pick the one that looks cheapest or easiest on paper.
Thinking, great, I'll save $5,000 right now.
Right. But they don't realize they've just built their house on sand because that cheap structure doesn't actually let them do business the way they need to.
And they face this massive operational friction.
Exactly. They can't get a bank account or they can't hire the staff they need, and they end up spending 10 times that initial saving just trying to fix the mess.
Okay, so let's dismantle this. The guide proposes a very specific order of operations. It says, strategy before structure.
This is the core principle. It's everything. Jurisdiction follows activity.
Let's unpack that. Jurisdiction follows activity. It sounds like common sense, but I have a feeling people get it backward all the time.
Constantly. They incorporate first because it feels like you're making progress, and then they try to figure out the business model. No, you have to map your revenue flow first. I mean, literally draw it on a whiteboard. Who are your clients? Where are they? How does the money actually move?
Give us a real-world example. Let's say I'm a consultant.
Okay, sure. Let's say you're a business consultant in Dubai, but all your clients are big corporate firms in, say, the EU.
Right.
You don't need a storefront in Dubai.
Right.
You're not selling coffee. You don't need to import physical goods.
So I don't need a warehouse or some fancy office.
Correct. What you need
Right.
is clean international invoicing and, crucially, a structure that looks credible to a European bank's compliance officer.
Ah.
Because if you pick some budget-free zone that banks associate with, high-risk shell companies, your German client's bank might just flag the payment.
So the jurisdiction itself is a signal of credibility.
100%. Now, compare that to a software firm, a SaaS business. They're billing thousands of small subscriptions globally. $20 here, $50 there.
They need a payment processor, the Stripe, checkout.com, something like that.
Exactly. And those processors are notoriously strict. If you get a general trading license because it was on sale, but your activity is clearly software services, they'll see that mismatch and just ban you.
That's a nightmare scenario. You launch, people try to pay, and the gateway just says, account suspended.
All because you bought the wrong license to save a few bucks.
Right.
And then you have, the physical trader, the electronics importer.
Right.
If you're bringing goods in from China to sell in the UAE, you need logistics.
Mm-hmm.
You need port access, customs codes. If you set up in some service-focused free zone miles from a port with no warehouses, you've just created a logistical headache for yourself.
So if the structure doesn't align with how you make money, the whole thing just grinds to a halt.
The banks question it. The regulators demand more substance. And you're back at square one, paying a consultant to fix it all.
Okay, so once we've mapped the flow, we have to pick a type of company. The guide breaks this down into three pillars: mainland, free zone, and offshore. And I feel like these terms get thrown around a lot.
They do, and they are very distinct legal animals. Let's start with mainland.
The heavyweight class.
In a way, yeah. A mainland company is licensed by the Department of Economy and Tourism. Its superpower is scope. It can operate across the entire UAE and contract directly with anyone.
So if I want to open a restaurant or a construction firm or sell consulting services to the Dubai government,
You go mainland, it gives you the widest possible market access.
what's the catch then? Why doesn't everyone just do that?
Tighter regulatory oversight and cost. You generally need a physical office lease, and they will inspect it to make sure you're not a ghost. You have to follow Ministry of Labor rules very strictly. It requires a real footprint.
Okay, pillar two, the free zone. This is what most international founders have heard of, right? The 100% foreign ownership pitch.
Yes, although mainland allows that for most activities now too. That's a pretty recent change. But free zones are still popular because they're like special economic zones. Think of them as bubbles.
Bubbles?
Yeah. Inside the bubble, you have your own regulations, sometimes your own courts, and a simplified tax and customs regime.
But there's a fence around the bubble.
A very high fence. A free zone company is generally not allowed to trade directly with the mainland market.
So if I'm in a free zone, I can't just walk down the street and sell my services to a local Dubai company.
Not directly, no. You typically need a distributor or branch. They're designed for international business or business within that zone. And here's the nuance. They vary wildly.
Right, there are dozens of them.
Some are for commodities and logistics. They have ports, warehouses. Others are for tech and media. They have co-working spaces. The license has to match the work. You can't just pick a free zone. You need the right one.
Mix them up and you confuse the banks.
Precisely. And that brings us to the third pillar, offshore.
This is where that cheap trap really bites, isn't it?
It really is.
Yeah.
We're talking about entities like RAK ICC or JAFZA Offshore. These are international business companies.
What are they good for?
Holding structures,
Yeah.
holding assets like real estate or intellectual property. But, and this is key, they are prohibited from doing commercial activities inside the UAE.
So no office, no staff in the UAE.
Generally, no. And here's the big warning from the guide. They do not automatically provide tax advantages anymore, and they often face massive banking restrictions if there's no substantive footprint.
Meaning the bank looks at it and just says, nope, that's a shell company.
Exactly. To a compliance officer, an offshore company with no office and no staff just screams money laundering risk.
So this leads us perfectly into the biggest hurdle in this whole process. The license, you're saying, is the easy part. The real boss fight is the bank account.
It's the ultimate reality check. I have seen founders get their license in 24 hours, they pop the champagne, they post on LinkedIn, and then they spend the next 8 months trying to open a corporate bank account.
Why? What's going on inside these banks?
The banks are the real gatekeepers. They are under immense global pressure on anti-money laundering, AML, and Know Your Customer, KYC, regulations. The UAE has worked incredibly hard to meet those standards, and the result is that banks are hyper-vigilant.
So they're not just being difficult for fun, they're terrified of getting fined.
Terrified. When a bank looks at your application, they're asking one simple question. Is the cost of verifying this person worth the money they're going to deposit?
That's a pretty brutal calculus for a startup.
But it's the truth. If you have a complex structure or clients in high-risk countries and some vague business plan, you are a high compliance cost client. They'll just reject you to save time.
The guide mentions demonstrable operational substance. What does that mean in plain English?
It means, are you real? They want to see the source of your funds. Where did the startup capital come from? Savings, investors? They want to see your source of wealth. But mostly, they check for rejection triggers. Inconsistent narratives are a big one. Your license says marketing, but your business plan talks about crypto trading. Rejected. You don't have any contracts or invoices to show. Rejected.
The guide also mentioned a website, which kind of surprised me.
It's a huge point. It seems so basic. But if you don't have a functional professional website that matches your licensed activity, the bank sees that as a massive red flag.
So if my license says software development and my site just says under construction?
Good luck.
Yeah.
Or if your website talks about investment advice when your license is for management consultancy, that mismatch scares the bank.
It's amazing that something so simple can stop a business cold.
It's all about credibility. The guide mentions a solution, what experts like the consultancy Mainland and Dr. Pooyan Ghamari call the bank readiness file.
Okay, what's in this secret agent file?
It's a preemptive strike. It's everything the bank might ask for, all assembled before you even apply. First, proof of fund origins. Not just a story, but bank statements.
Yeah.
Second, a realistic business plan. And third, this is key client proof. Not just, I hope to get clients, but here's a letter of intent from a real client, or here's a contract I'm about to sign.
You have to show them that money is actually waiting to flow into this account.
Precisely. And finally, evidence of decision-making capability in the UAE. Are you a resident? Is the management actually here? If you're just a ghost living on another continent, the bank is not interested.
It seems like the days of the paper company are well and truly over.
Completely. And that extends to taxes, too. That's the next big shock for people. The UAE is no longer a tax-free free-for-all.
I think a lot of people are probably still operating under that old assumption, I'm going to Dubai, so I pay zero tax. Break it down for us.
Well, the landscape is completely shifted. There's now a corporate tax. Generally, it's 0% on taxable income up to 375,000 dirhams. That's about 100,000 US. But above that, it's 9%.
And that applies to everyone.
It depends. Mainland, yes. In a free zone, there are exceptions. You might be a qualifying free zone person and still pay 0%.
Qualifying sounds like a trap word.
It is. It's very strict. You generally have to derive your income from other free zone entities or from specific qualifying activities. If you're in a free zone but you're doing most of your business with mainland clients, you could disqualify yourself and get hit with that 9% tax.
So you can't just assume it's zero. You actually need an accountant.
You need an accountant. And then there's VAT value-added tax. That's 5%. Once your turnover crosses a certain threshold, registration is mandatory.
So the days of running your business out of a spreadsheet and a personal bank account are gone.
Long gone. Compliance isn't an annual thing you panic about in December. It's an ongoing discipline. You need accurate bookkeeping, audit-ready records. If you don't have them, you're just setting yourself up for fines.
And this brings us back to that cost trap.
Yes, you have formation costs, the one-time fee to get the license. Everyone budgets for that. But they forget about the recurring obligations.
The subscription fees of just running a business?
Exactly. License renewals, visa processing, Emirates ID fees, economic substance filings. It all adds up. And a cheap initial package might have a zero visa allocation.
What does that even mean?
It means you have a license, but you can't hire anyone, not even yourself sometimes. So when you go to hire your first employee, suddenly you have to pay a massive fee to upgrade your package, or you suddenly need a larger office because the cheap package only gave you a flexi desk.
It's all about the total cost of ownership, not just the sticker price on a website.
Exactly. You have to look at the cost over 3 years, not 3 hours.
Let's pivot to the human side of this. Visas and residency. How does that all connect?
Visas are tied directly to your license package and, crucially, your office size.
The office size affects how many people I can hire.
It does. Broadly, the government uses office space as a proxy for how many employees you can reasonably have. Usually it's something like 1 visa for every 9 square meters.
So you can't hire 10 people and have them all work out of a virtual office.
No. You try to scale your team without scaling your real estate, you hit a wall. A small software team can start with a flexi desk and a couple of visas. But a trading operation that needs 5 staff on day 1, you need a physical office immediately to get those visa quotas.
It sounds like everything is interconnected. The license, the office, the visas, the bank. You can't solve for one in isolation.
That is the perfect summary. It's an ecosystem.
The guide also mentions holding structures, using one company to protect another.
It's a sophisticated move, but a very smart one. Imagine you're a tech founder. Your most valuable asset is your IP, your code. If you put that IP inside your operating company, the one signing contracts and taking risks, it's vulnerable. If a client sues you or a deal goes bad, your IP is on the line.
So you separate them?
Yes. You might use an offshore or free zone holding company just to own the assets. Then you have a separate operating company that licenses the IP and does the actual business.
So if the operating company gets sued, the software code is safe over in the holding company.
That's the idea. It separates operating risk from asset ownership.
Yeah.
But again, you need professional advice to set that up so the banks understand what you're doing.
And what about when things end? The guide talks about clean closure.
This is so critical. I've seen founders just leave. They decide the business isn't working. They get on a plane and they stop answering emails.
The Irish goodbye of business.
It is a terrible, terrible idea in the UAE. You cannot just abandon a company. You have to formally cancel the visas, close the bank accounts, file the final returns.
What happens if you don't?
The penalties just accumulate. And they stick to you personally.
Yeah.
If you ever want to come back or even just transit through Dubai airport 5 years from now, you could get flagged.
That's a chilling thought, these compliance shadows that follow you.
They do. So you have to pay to close properly. You appoint a liquidator, you clear your dues, and you get a formal deregistration certificate. It costs money, but it buys your freedom.
It's clear the UAE is growing up. The Wild West days are over.
That's it. The opportunity is still massive, arguably bigger than before because the market is safer. But the barrier to entry now is competence.
So the role of an expert, a consultancy like Mainland, isn't just to get you a license.
No, anyone can click a button online. Their job is to architect the narrative. They align your business model with the right license, the right bank, the right tax structure, so that the whole story is coherent. They're translating your business into a language a conservative banker understands.
Okay, let's bring this all together. What does this all mean for the listener who's sitting there with a business plan ready to click submit?
It means pause. The key takeaway is that the right jurisdiction is the one that minimizes friction, not just the one that costs the least upfront.
Friction, that's the word. You can pay with money, or you can pay with time and stress.
Exactly. If your bank account is frozen for 3 weeks because you picked the wrong license, that friction costs you far more than the $2,000 you saved.
Pay a little more upfront to pave the road.
Build a structure that banks trust, that regulators understand, and they can actually scale with you.
Here's where it gets really interesting for me. We usually think of the government as the boss, right? They give you the license. But from all this, it feels like the bank is the real boss.
And that's the provocative thought for today. If the bank account is the hardest thing to get, harder than the visa, harder than the license, shouldn't you view the bank as the primary entity you're trying to satisfy?
It changes your entire perspective. You're not pitching the licensing authority, they'll take your money. You're pitching the compliance officer at the bank.
Precisely. And if you build your business structure to satisfy a conservative banker, you will almost certainly satisfy the regulators and the tax authorities by default.
That's a solid rule of thumb. Build for the bank.
It's the safest bet, because if it's bankable, it's usually legal. But if it's legal,
Yeah.
it's not always bankable.
Well, there you have it. Before you chase the lowest price tag, chase the path of least resistance for your actual money flow. Check your strategy, build your bank readiness file, and please do not get caught in the cheap trap.
And remember, knowledge is only power if you apply it.
Thanks for listening to The Deep Dive. We'll catch you on the next one.